It was another wild session on Wall Street with the S&P 500 falling well over 1%. We also saw the Nasdaq Composite and the Russell 2000 down over 2%. There weren't a whole lot of places to hide out here today. Only 17% of the stocks out there closed in the green. The areas that did were in some of the more boring areas of the market like consumer staples. In fact, the dividend yield ETF hit an all-time high here today on the same day that the communication services sector ETF was hitting multi-month lows, of course following yesterday's horrendous sell-off in Netflix shares and continued sell-off in many of those names here today. So it's been a wild market. We're going to talk about what all that means for our broad posture using the market forecast technical indicator in tonight's video. Then we're going to get into our trade application example where I wanted to focus on a lesser known dividend growth investing stock from the materials sector that's approaching an attractive yield. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 21st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, then go down below into our description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. And also remember, at the bottom of those emails, you'll find the stocks that are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee, and I really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you might know by now, it was a pretty ugly day on Wall Street. As you can see, there was a whole lot of red out there in terms of individual price action. You do have one standout performer that kind of stands out like a sore thumb there, and that is Tesla. It did end up rallying by 3% here today, so it did produce a pretty nice green square there on a large market cap of just over $1 trillion. However, I would also add that Tesla did not close near the highs of its session, so it was actually up quite a bit more earlier on in the trading session and kind of sold off towards the end of the day. But still, don't want to take anything away from them. That was a nice performance on a difficult day for a lot of other risk-on types of stocks that are out there. In a lot of ways, Tesla has kind of become like Teflon, which is quite interesting considering that there are a lot of professional traders that have been shorting Tesla over the years. And so of all the stocks they could have picked, to be picking on Tesla that just refuses to go down must be a frustrating experience for those folks. And of course, having Elon Musk toying with them, I know as a gag he was sending red shorts to the folks that were publicly short Tesla over the years and having a little bit of fun with them. I doubt they appreciated that all that much, but it is interesting to watch, to say the least, to see that of all the stocks that are kind of sticking up there near their all-time highs, Tesla, a stock that a lot of people believe is incredibly overvalued. Remember, its shares are worth more than the rest of the automobile industry in the United States. If you were to add up, GM and Ford and all those, Tesla's market cap is larger than all of those combined. And so you can understand why people who focus purely on the fundamentals might want to short Tesla, but it has not been an easy road for them whatsoever. So for those of you that have stuck with them thick and thin, congratulations, you had another big winning day here today. Other than that, you don't see a whole lot of green patches out there. A few of them kind of one-offs. You got a AbbVie, you got a Bristol Myers Squibb, and you got a Abbott Labs there in the healthcare space that managed to be in the green. You've got Verizon and AT&T from the old school telecom area still in the green here. And then you've got IBM as kind of a follow-through from yesterday. Some of you might not be aware, but IBM actually had quite the stellar performance yesterday, up like 7%. So it tacked on another 1% here today after recently announcing its earnings. but it's kind of few and far between in terms of the green slots here. If there was any consistency out there earlier in the session, it was actually from the consumer staples. Now, at the end of the day, even the consumer staples did fall into the red, but there were still a number of nice green consumer staples out there. I actually talked about Coca-Cola a little bit earlier today in my question and answer session. It was hitting new all-time highs here today, and a lot of people, scratching their heads, befuddled on how Coca-Cola's valuation could be richer than something like Facebook, and watching those two companies go in opposite directions in recent months. Remember, the market is not always rational, and sometimes the market wants to pay up for consistency, whereas when you've got Facebook/Meta these days, pouring billions of dollars into the metaverse, not knowing what the outcome will be, you can understand why investors feel a little bit more comfortable with a beverage company that has fairly consistent revenues. I'm not saying it's right. I'm not saying it's fair. It is what it is. Dividend stocks are having a moment right now, and I couldn't be happier about it personally, so I'm thrilled about it. But Coca-Cola wasn't alone there. Walmart was also up. Cisco, a dividend aristocrat that not a lot of people talk about. That's not Cisco, the tech company. This is Cisco, the food distribution company, was up. Kroger was up. Walgreens, another dividend aristocrat, was up. So, Walmart, Coca-Cola, Cisco, Walgreens, those are all dividend aristocrats. You also have Colgate, that's a dividend aristocrat. It was up today. You also have Kimberly-Clark, that was an aristocrat. It was up today. Clorox is an aristocrat. It was up today. You're sensing a theme here, right? And even beyond the aristocrats, you had, Kraft Heinz and Kellogg up. You had General Mills up. You had Mondelez up a little bit. You had Philip Morris up. You had Altria up. So what brings all those together? Well, a pretty boring business model for one, and sometimes you're in a part of the cycle where that's what investors are seeking out. In fact, some of you might have caught this tweet of mine earlier today, but if not, let me spend a little bit of time bringing it up because I think it is important. I had mentioned not a great look for the markets right now from a sector rotation perspective. The top 4 rankings on the sector selector, so this is what I show you guys in these videos each week that we use at Market Scholar. So it's really for my Monday top-down trend trading class, but I oftentimes bring up the results with you guys here in these free videos as well. Suggest the possibility of markets being in a late expansion to early contraction territory. So if I were to click on that a little bit to zoom in on it so you can see it a little bit better, you can see what I'm referencing there. This is your typical sector rotation model up above here. This is actually taken from something that I had printed off many years ago. So this is the type of thing that you would find in a textbook. What you see down below is something that I update personally every single week. And it just so happens to be that the 4 sectors that you find in this late expansion to early contraction period, basic materials, energy, consumer non-cyclicals, and utilities, are the exact 4 that are showing the most strength at this moment in time. So again, basic materials matches up with materials, and another way to say consumer staples is consumer non-cyclical. Sometimes people use the language of consumer cyclicals are consumer discretionary and consumer non-cyclicals are consumer staples. So just a little bit of variance in the language there, but they are one and the same. So energy, materials, consumer staples, and utilities are this market's current leaders, and evergreen content from textbooks suggests that that is the leadership group that you would expect when we are in a late expansion, early contraction phase. So in other words, not a great look right now. Someone had mentioned earlier that they thought that I was pretty bullish in this market, and I'm like, wonder how that interpretation came out. I don't feel particularly bullish. Maybe you hear my enthusiasm around the fact that consumer staples are doing really well, because it is true that consumer staples are my personal biggest sector, but it's not because I selected them for this moment. I bought the consumer staples over the years because they happen to be dividend growth companies, not necessarily because I was preparing for April of 2022. So I can assure you I'm not wildly bullish here. There is a lot of evidence out there that suggests that these are not ideal times to be in the market, and this is just one of those moments right here. So keep that in the back of your mind as well. Remember, it doesn't always work out as planned, so this is not meant to be scare tactics or anything like that either. As a long-term investor, I'm always looking for opportunity. So whatever market wants to bring to my attention, I will be willing to accept it, and I will keep my eyes open towards those opportunities. But for those of you that are a little bit more short-term oriented and short-term trading compared to myself as an investor, then this is some of that evidence that you would look at and say, yes, these are difficult times. This could be an environment where you put on more bearish trades, or if you're doing bullish trades, perhaps you're doing what I've been doing for the last couple of months, which you guys are probably getting sick of, but nonetheless it's been working, which is selling puts on stocks. So while that's not a bearish trade, it is a bullish trade that provides a lot of flexibility on how you would end up losing money on it. So it is not very directional in nature, right? Because we're selling out of the money puts. So, and even in the bullish trade that I did the other day, while you didn't see it here on the heat map because Lindsay Corporation is not big enough to be in the S&P 500, I am happy to report it was up a little bit today. On a day like this where we have so much selling all over the place, you might think that you'd have to get awfully lucky to have selected a stock that shows up in the green, but we were able to accomplish that. Now, we've got a long ways to go in that trade, so it's too early to be, rounding the corner and assuming that it's going to end up working out. But I am happy to report that at least in the rare directional bullish trade that I featured in Tuesday's video, it was up today on a day when most stocks in the market were down. You can see that NVIDIA and Salesforce and Meta, they all got hammered here today, as did PayPal, as did Fortinet, as did AMD. Even Amazon got beat up. So naturally, when you have a market that looks like this from a heat map perspective, it was a difficult day because you had the vast majority of your mega cap companies down, with, again, the only exception really being Tesla there in that regard. So when that happens, then you should assume that it's going to be a tough day for the S&P 500. And indeed it was. One other way to kind of measure how difficult or how good a day is by looking at this Market Watch visualize area that I always like to point out to you guys when we have a one-sided day. And today was another one of those one-sided days. You can see that when I pull up the S&P 500, this suggests that only 88 out of this S&P 500 was up today. So 88 stocks out of the S&P 500 stocks. So that works out to, only about 20% or thereabouts, to maybe 21% if you wanted to be precise. So, somewhere in that general vicinity, and the way that you would kind of calculate that is just simply take the 88 and divide it by the 500 components, and you're right around that territory. It wasn't quite 20, it was 17%. So that gives you a sense. It was a difficult day to be in that 17%, but if you owned a bunch of consumer staples that are dividend growth stocks, or if you happen to be lucky enough to be in that Lindsay Corp and other one-off plays like, Verizon or, AbbVie or Bristol Myers Squibb or some of those others that I mentioned, you should know that you should feel lucky about that, because most stocks were down today. It was difficult to find positive stories developing after a day like today. The vast majority of companies closed in the red, and many of them quite considerably, right? This was not just an average day where stocks just barely went lower by 0.2% or something along those lines. This was a day where it wasn't too hard to find stocks that were down 7, 8, 9, 10% here today. So a tough day. And again, it just kind of gives you the sense that the bears are much more prevalent in this market than they had been in recent years, and you could get away with saying that they are in more control of this market right now than the bulls are. Whether that continues to be the case is anybody's guess. What we tend to see going into a midterm election year is that the markets will get a bit more bullish as we head towards those elections. Those in power want to do everything in their power to stay in power, and therefore perhaps enact positive economic stimulus or different things like that. Now, obviously, this time is going to be a little bit more challenging in that regard because the Fed is already on record stating that they want to raise interest rates considerably between now and the election. So how that all gets rectified is anybody's guess. But, maybe you're looking at that and saying, well, things will get better before they get truly worse. A lot of people are expecting a legitimate bear market to happen in 2023. Some of you might be saying, well, aren't we already in a bear market? Not from the broad markets perspective, we're not. Perhaps in some of the niche areas within the market we are, right? The ARK, Cathie Wood phenomenon, I would say, is definitely getting hammered. And so there's definitely some bear markets happening underneath the surface. But at the broad S&P 500 level, we're not in a bear market. And it's entirely possible that we're overdue for one, right? Because while we had a significant pullback in price during the coronavirus time period where the markets did collapse 35% out of nowhere, it was immediately unwound. It was the fastest recovery in history. Within a couple of months, we were right back to break even from that V-shaped rally or recovery, and we eventually went on to hit all-time highs by the end of 2020. That is not a typical prolonged bear market the way that we tend to think of them, like you would think of 08, 09. That was a real bear market where you had to not only suffer through price like we suffered through with the coronavirus, but the difference there is we also suffered through time. It took 18 months or whatever it was a year and a half before we finally got back on track. And so we're probably due for one of those types of markets again. I'm more optimistic that it won't be a 50% pullback the way that we experienced in 08, 09. Remember, those are relatively few and far between throughout history. So I am somewhat hopeful and optimistic that when we do have a prolonged bear market, I'm hoping that it's only going to be in kind of the 30% range, maybe 35% range, not one of those extremely once-in-a-generation 50% meltdowns. But still, even 35% is going to feel terrible whenever it shows up, if it shows up. So, there's a lot to think about there, but obviously if you're trying to be nimble as a trader, there'll be ways where you can benefit from falling stock markets at that time through bearish trades. And for those of you that prefer not to be active as traders and instead looking for opportunities as investors, that's where it probably makes sense to keep an earmark of cash in your portfolio waiting for whenever that day may come, because again, we are a bit overdue from that perspective. But let's talk about what's happened more near term here. And you can see that once again, we had this 1% down day here. Remember, on Tuesday, we had the 1% up day. And anytime we have an either 1% move in either direction, I like to bring up this chart to give us all a sense as to whether we are operating in a more volatile environment for trading or a less volatile environment for trading. And you can see here that it's pretty obvious, at least to my eye, that the growth higher and the drop lower in these vertical lines, green on the up and red on the downside, are much more exaggerated since basically the end of November. These are much bigger moves up and down, basically telling you it has been more whipsaw-y and much more volatile than what maybe some of you are comfortable with, right? If you started trading a year ago and your first encounter with the investment world was what happened from April of last year to August of last year, where you just had this nice coasting process, you might have thought that investing was easy. It's never meant to be easy, right? Sometimes we say in the world of long-term investing, it's simple, but it's not easy. It's simple to enact a long-term investing plan, but it's not easy to sit through the difficult moments like we've been dealing with more often in the most recent couple of months here, where there's been a lot more aggressive selling. And so back here, these bars were somewhat limited or muted in comparison to the exaggerated bars that we've been seeing here more recently. So it has been more difficult. If you feel uncomfortable, don't feel embarrassed by that. It is part of the learning process. I started investing in trading back in late 1999, early 2000. That was during the dot-com bubble. So if you're somewhat new and feeling this uncomfortable feeling, understand I know exactly what you're going through. I felt the exact same feelings back during the dot-com bubble 20 years ago. So if I survived that, you can survive this. That's my plea to you. Just keep your eye on the prize and remind yourself not to blow up your accounts along the way. As long as you can survive, you're going to be in a much better position to benefit from any recovery that will happen. And they will happen, right? What we know for a fact is that bear markets happen. What we also know for a fact is that bull markets happen much more often and at much more aggressive rates. So holding through bear markets, or at least surviving through them, is effectively your fee to enter into the amusement park that is the stock market that will eventually produce immense wealth for some folks. Now, how you handle yourself through all of that determines whether you will be successful in your efforts or not. But I am here to say that over the long term, the stock market is a perpetual wealth generating machine, as I stated on Twitter here over the weekend. Some of you might have seen that tweet. And what I'm kind of referencing is, obviously if you pull up an all-time chart of the S&P 500, that's what it looks like, right? Do you want to get off of this ride? Probably not. If you're kind of, trying to pick and choose your moments, I can understand that. Again, some of you are going to be much more active in the short term than I am. But the main thing I want to do is ensure that I survive whatever storm is coming in front of me, because I do not want to get off of this ride, right? That is a wealth generating ride, and I want to participate more often than not. And so we all got to do our best to keep a calm, cool, collected demeanor and head on our shoulders in order to survive through the difficult periods, in order to enjoy this wealth creating machine called the stock market here in the United States. Let's go ahead and take a look here at chart 4B. And this is going to be our foregrid to look at what our posture would be using the market forecast technical indicator. So when you hear me use terms like bullish or bearish, it's not necessarily what I think about the future. What I'm referencing in this regard is how to read the market forecast technical indicator. It's not Brandon's thoughts here. It's the market forecast posture setting mechanism, right? And most of you know that David and I used to do these videos at the prior company we worked for back at InvestTools/TD Ameritrade, and it used to be called the market forecast video back then, so it was maybe a little bit more obvious that what was driving our conversations during the video was the market forecast technical indicator. Since we left that company, they asked us not to use that term with our video, which is understandable, so that's why we call it the market outlook video these days, but it is still the market forecast technical indicator that drives when you hear David and I use terms like bullish posture or bearish posture. And specifically what we are referencing is this green line on the market forecast technical indicator. So today, our posture is now bearish. It's not Brandon's posture, it is the posture of the market forecast technical indicator that suggests that the posture on the S&P 500 is now weakly bearish. Now notice today is a good day to kind of educate ourselves around that topic as well, because we actually have a wide variety of postures that are popping up on our 4 different charts at this moment in time. The background colors of the charts are meant to help you see visually what those postures are very quickly without having to think too hard about it. So when you see the light pink background color like we see up here with the S&P 500, that means we have a weakly bearish posture. If you see the dark pink background color like we see down below here on the NASDAQ composite and also on the Russell 2000, that means on those charts, we have a strongly bearish posture. And again, I use the term we quite loosely there. What I really mean is the market forecast technical indicator shows a strongly bearish posture on the NASDAQ composite and on the Russell 2000. And then the oddball of the group is up here on the Dow Jones Industrial Average, which, as I alluded to on Tuesday, we spent a little bit of time talking about this. The Dow Jones is currently the leader of this market if you're talking about the leader to the bullish side, right? A lot of times people reference leader as being bullish and laggard as being bearish. So the the best performing index at this moment is the Dow Jones Industrial Average. As I mentioned on Tuesday, that's where you're going to find Coca-Cola. That's where you're going to find Johnson & Johnson. That's where you're going to find Procter & Gamble. And these kind of big, bulky, blue chip, dividend aristocrat, dividend king types of companies. Right? Dividends have actually done well in this market environment. If you were to look at, let's leave the Dow up there for a second, but let's kind of change the S&P 500 to DVY. You can see that DVY literally hit all-time highs today. So if there's a segment of the audience that thinks we are for certain in a bear market right now, what is Brandon talking about here? This is what I look at, right? I am a dividend investor. So to me, it doesn't feel like we're in a bear market. And again, I acknowledge there are plenty of niches underneath the surface that most certainly are in their own bear markets. Hopefully you can see the flip side of the argument as well, where there are a lot of stocks out there that are actually hitting all-time highs at this exact moment in time. Therefore, it would be hard to call it a bear market if that's the case. If we have Coca-Cola as just one example in that DVY, literally hitting all-time highs today, it's hard to say that we are in some sort of death spiral bear market at this moment in time. I will acknowledge it's not a great look because, again, when consumer staples like Coca-Cola are doing particularly well relative to other sectors, it basically gives you the impression that market participants are in a risk-off mindset, not a risk-on mindset. They're hunkering down in what they know. They're hunkering down in safe businesses. So it's not a great overall market environment. That is not the point that I'm trying to make. But it is also true that there are still plenty of stocks that are doing quite well in this market environment. It is not just a complete onslaught of selling like we saw in 08-09. Maybe we get there, maybe we don't. We'll all find that out together. What we know right now is that the Dow Jones, where you find a lot of those big blue chip names like Coca-Cola, has held up a lot better than your small cap universe down below with the Russell 2000. It's held up a heck of a lot better than your hyper growth area of the NASDAQ composite. And it's even held up better than the venerable and somewhat diversified S&P 500. But remember, these days, because of what I show you guys regularly on this chart right here, or this heat map, these bigger squares and rectangles reference the market caps of these companies, letting you know that they are the drivers of the S&P 500, right? And so if you looked at all of these 500 names here and you said, oh yeah, Apple, Microsoft, Amazon, Nvidia, Alphabet, they all look lots and lots bigger than something really tiny. Let's see if we can point out something that is extremely small. I don't know. There's probably a number of them I could look at, but let's just pick on this one right here, whatever this is. Phillips Van Heusen. It's a $5 billion company, right? It's a clothing company. It's only worth $5 billion. Then you look at Tesla right next to it, and it's a $1 trillion company. It's night and day the difference or the impact on the S&P 500. The bigger you are, the more impact you have. Phillips Van Heusen could probably go up and double tomorrow, and it could get a buyout offer, and if it went up 100%, it probably wouldn't even move the needle on the S&P 500. Whereas if Apple fell 15% tomorrow, not even 100%, but 15%, it would have a monumental impact on the overall S&P 500, right? So the the S&P 500 is more diversified, but the problem is the biggest market caps these days are in the tech space. And so you could get away with saying that the S&P 500 looks a lot more like the NASDAQ composite in this current era than it ever has, right? That hasn't been the case historically. In the old days, it used to be General Electric. That was the biggest driver of the S&P 500, or ExxonMobil, right? And these days, it's Apple, it's Microsoft, it's Tesla. And so there's definitely a more digitized and technological tilt towards the S&P 500 today compared to in the past. So that's why today, when you're thinking about those old line companies, you oftentimes are thinking about the Dow Jones Industrial Average. And if you're in a market that wants to hunker down in Coca-Cola, then your best proxy for that kind of mindset from a broad market perspective is the Dow Jones Industrial Average. And so it's no surprise to me, at least, that it is the one that continues to retain its value better than the other indices, despite the difficult markets we've found ourselves in. So notice the difference with the Dow compared to the other three. Not only does it have a dark green background telling us that we have a strongly bullish posture on it, but we also have a green moving average. And notice on the other three charts, none of the others have a green moving average. For those of you that are newer, that green moving average, which is a 30-day moving average, suggests that price is above a rising moving average. So there are a number of stocks in the Dow that are actually doing quite well right now. Whereas you can't really get away with saying that quite as easily with the other indices. With the S&P 500, you now have a yellow moving average. In this case, it means the moving average is still rising, but price is now below it. With the NASDAQ Composite and the Russell 2000, today was such aggressive selling days that you bent the moving averages lower as a direct result of the terrible day that today was, right? This was a pretty aggressive 2% down day on the NASDAQ Composite and a 2.29% down day there for the Russell 2000. So not only was it a violent enough day down to push us to multi-week, if not multi-month lows on the NASDAQ Composite, notice where we closed. You'd have to go all the way back here to middle of March since we were last trading there. With the Russell 2000, it's not quite breaking those lows of where it was on April 11th, but another down day tomorrow, and all bets are off. So regardless, both of them had such terrible days today that it literally bent the 30-day moving average lower because of how terrible today was. And with price now below those falling moving averages, the moving averages have now turned red. So that's another way to identify. You don't just have to take my word for it. Like I said on Tuesday when I said the Dow was our leader, now you can literally see it with your own eyes why I might suggest something like that, right? You can also read those intermediate labels, and knowing that the Dow is at 76, whereas S&P 500 is at 54, NASDAQ's at 39, and then we have the Russell 2000 at 38. All of those are dramatically lower than what we see there with the Dow. Is another way to identify that the Dow is currently the leader of the market. So, I don't think that's a good look either, right? Going back to what I'd mentioned before on Twitter regarding the sector rotation model, this is another way to interpret the information from a broad index perspective to ask yourself, are we really, really bullish here? Of course we're not. If we're being led by the Dow Jones Industrial Average, the stodgy old companies, that is not a great sign for the risk appetite of the market at large. So to cap it off, S&P 500 down 1.48% today. Dow Jones was our leader by only being down 1.05% today. NASDAQ Composite down 2.07%, and then the worst performer today was that Russell 2000, down 2.29%. Let's step away and head on over to the internet for a second. I always like to get a chance to say thank you to those of you that help support these Market Outlook presentations. Remember, they are free of charge to you. We will do them whenever we have free time. Hopefully you guys get benefit out of them. But we don't get paid to do them. So hopefully you guys are flexible with us around that as well, and somewhat patient with us, knowing that we really don't have a whole lot of motivation to actually do them. Yet we do them nonetheless. A labor of love, I suppose you could say. But a constant reminder that each time we do these videos, it takes more than 3 hours to do. So it takes us away from our families and everything else that's in our life. So again, we need you guys to help support them if you get value out of them. If you don't get value out of them, then that's fine as well. We can step away from them for a while or do them less often or what have you. That's fine. We just want to make sure that our efforts are going into the right places, right? And if they're not going into the right places now, perhaps we could figure out something else where they could go into the right places. But you guys have done a great job helping support them. when I did the video last time around. 103 of you clicked like there for me. And as I always tell you, as long as we're up into the triple digits, I will plan on doing a full-length video for you the next time I'm scheduled to do the videos, which is why we are doing a full-length video right here, right now. And so we barely got up over 100. For those of you that are stragglers and aren't quite able to or willing to click like, keep in mind that I like to always say that I think it's a good trade-off for your 5 seconds of time if you want access to our 3 hours of time, right? And maybe you disagree with that, and that's fine as well. Again, if we're not making a positive impact with these videos, then there's no reason for us to do them. And you guys will let us know by the lack of support on Twitter and other social media venues there as well. So keep up the great work. Thank you to the 103 of you that were willing to do that for me the last time around. Ken and Adrian and David and Roger, Arth, Pat, Doug, Jean, Walter, we've got Kirk and Ron and Gerald and Dale and Paul and Surendhar, Pam and Carl and Chandu and T-Fib and Jayesh and Violina, Rick, Ken, Keith, Austin. Too many to go through, but I do see it coming through. Whenever I get my notifications, I see all of your wonderful names coming through, and I know that you guys are there to support us. So thank you very much for doing that. Please keep that up on your end. Again, assuming you want these longer form videos. If you prefer that I only give you a 15-minute quick hitter video on only the indices with no trade application example, then don't click like, because if we're under 100 likes, then I'll just give you a modified version of it. So it's up to you, and hopefully you're getting continued value out of these videos from both David and I. Also, while we're over here, I want to remind you that we had a full day of classes here once again at Market Scholars for our premium members. I teach my question and answer session on Thursday mornings, and David teaches his portfolio management with ETFs class on Thursday afternoons. And so for those of you that aren't familiar with our schedule, we teach 10 different premium classes throughout the week. David teaches 5 and I teach 5, but we each teach a question and answer session at the end of our week, so that way we can kind of circle back to questions that might have come up earlier in the week. Think of it as kind of an Ask Me Anything approach, or an AMA for those of you that are hip to the acronym there, and it's an opportunity for our students to work more directly with David and I and pick our brains about their topics that they're interested in. So today I got questions about how to interpret Elon Musk and his Twitter hostile takeover. I got a question about how to utilize my drip tracker spreadsheet that I make available to my students in a unique situation where you buy a stock over multiple times as opposed to just one big batch. I also got a question about looking at Culp as a dividend growth investing candidate. I got a question about the idea of selling covered calls on Chevron now that its stock is in the orange zone of the dividend stair-step chart, right? We talk about the blue zone quite a bit, but we don't talk about the orange zone quite as much. So that is oftentimes a possible covered call candidate for my options for long-term investing plan. I got a question about BX. So that's not Black Rock, that's Blackstone, and whether it would be a good iron condor candidate. I got a question about a scan using the market forecast charts and whether we could pull out the stocks that are giving us overbought and oversold cluster signals. And again, that's what you guys get at the bottom of the emails we send you for this here very market outlook presentation I'm giving you right now, right? So you guys get access to that every single day as at least the results of that. I got a question about why do I focus on monthly contracts as opposed to weekly contracts with my sold puts. I got a question about, how David and I might approach the markets differently and if we come to a consensus on what our postures would be. And then I got a question on why we had a discrepancy in price on Costco. We were fortunate enough to shut down our bullish swing trade on Costco first thing this morning, but we got filled at a slightly worse price than we were expecting because of the advanced order type that we had set up with it. But I am happy to report at least we got out. I looked at the end of the day, and Costco actually ended up falling by the end of the day. So thank goodness we got out when we did, regardless of our price. But lots of good stuff there. If you are a premium member of Market Scholars and any of those topics sounded sounded interesting to you, feel free to go back and watch the recording that is now available. You can see that I timestamp all of those, so that way you can fast forward directly to the timestamps themselves. Also, while we're over here, and by the way, David's going to be teaching his technical analysis class tomorrow like he does on most Fridays, so make sure you're checking that out as well. Also, let's take a quick peek here at our factor selector tool. And as you can see, we have dividend yield up there back at number 1. That should not come as a surprise given what I just mentioned to you guys here a moment ago. Dividend stocks doing awfully well at a time when most other stocks are really struggling. We did find that quality fell to the bottom position. Now, if you open up the hood and look underneath the hood of the quality ETFs out there from a quality factor perspective, what you'll find is that there is a heavy dose of technology in there. Stocks like Microsoft would be quality stocks. And so sometimes people get confused around that and say, this is a market that seems to prefer quality, the quality factor. And I'm like, no, not really. What you're actually seeing is the opposite. You're seeing that this is a market that prefers dividend yield and low volatility. And in your head, you might be thinking those are quality stocks. And I wouldn't necessarily disagree with you there. But if you actually open up the ETFs of the quality ETFs, you'll find that they are chocked full of technology stocks. And they are definitely quality businesses in most market environments. But the problem is the stock market does not like technology stocks right now. And therefore, quality is kind of suffering the brunt of that as a result. All right, let's go ahead and get back on track now with some more Thinkorswim charts. Let's go ahead and do our chart 5A. This is our asset class 12 grid. Reminder that the background colors of these charts will signify what the current posture is according to the market forecast. Again, not my opinion. It's not Brandon's posture. It's the market forecast posture. And you can typically see why the market forecast would suggest that a certain chart is either bullish posture right now or bearish posture right now. If the charts are green, that means there's a bullish market forecast posture. If the charts are pink, that means there's a bearish market forecast posture. And as you look at the bottom rung, it should not be a surprise that they are green yet again. Remember, we talked about that exactly 1 week ago, and then I followed up with that on Tuesday saying that gold had slipped into a weekly bearish posture, but they've been able to stabilize enough where they went back to a weekly bullish posture. So that is maybe one of the differences that we are spotting here. On Tuesday, gold had that light pink background color. Now it's back to light green there, suggesting weekly bullish posture. The other charts that were strongly bullish on Tuesday continue to be strongly bullish here today. Despite oil stocks themselves falling today, we actually saw oil prices per barrel up today. So naturally, if we were strongly bullish on oil on Tuesday and it's gone up the 2 days since then, it continues to be strongly bullish. And that's one of the places you've been able to hide out in what has been a massacre in a lot of other areas of the financial world. Commodities themselves have held up quite well. In fact, have produced stellar gains for people who have been riding them the entire time. As you can see here, oil is basically up 28% in the last 3 months if you've been able to hold through thick or thin. Gold has not gone up nearly as much as oil, but still, I think considering the alternatives where a lot of growth stocks are down double-digit percentages, I mean, heck, some of those stocks are down 70, 80% from their highs, you can see the appeal of gold in a difficult market environment like this, where gold is up 6%, positive results over the last 3 months. You'll also see that the US dollar is up 5% in 3 months. Now, of the two, you might say, well, if gold is up more than the US dollar in the last 3 months, right, 6% versus 5%, then that means gold is more impressive. I would argue against that. 5% for the US dollar is monumental. 6% move for gold is a decent move, but it's not like, jaw-dropping. But a 5% move either up or down for the US dollar, the most liquid currency on planet Earth, in a 3-month period is dramatic. So this has been one of the bigger stories of this calendar year, and it was up nicely yet again today. It was up 0.3% there, and of course retains its strongly bullish posture. Off on the other side in the kitty corner, off in the lower right-hand corner here, we've got TNX. Remember, that's our 10-year U.S. Treasury yield. So these are not bonds. These are the interest rates on bonds. And remember, there's an inverse relationship between those two things. So once again, yields went higher here today. We're hanging out at about 2.92 right now on the 10-year. By the way, the 2-year Treasury yield is not that far away from that. So all of those yields are starting to bulk up to more legitimate levels here when we weren't too far removed from having negative interest rates and extremely low, like 0.2% interest rates just a year or two ago. All of a sudden, we're talking about 2 and 3% interest rates now, not 0.2, 2%, 3%. So they're actually offering some decent yields in the bond world right now. But of course, in order to get to those decent yields, bond prices had to fall in order to get there. So, the warning signals on the bond market have been ever present for years. You could probably get away with saying people have been sheepishly hesitant around bonds for the last decade. And for the longest time, most people who expressed caution around the bond world were proven incorrect, at least in the short term. But maybe they're getting their final last laugh now, because I think a lot of you that had to live through the 1970s and 1980s and were getting your mortgages back then, and even Treasury yields were over 10% back then in the early 1980s. I actually have a printout from one of my old value lines that shows that. So that was real. Government bonds were yielding over 10%. Even today, the I bond, I was talking about that a little bit in class today as well, the Series I government bond that is readjusted twice a year on inflation rates, even it's getting pretty close to double digits here all of a sudden. But back in the day, even normal, plain Jane, plain vanilla Treasury bonds were yielding double-digit percentages. So I think a lot of people got the sense that the bond market was way out of whack here in the last decade as we saw interest rates go all the way down to 1% or less. But, timing that move is always difficult. What we're witnessing right now might be finally that big unwind that people have been waiting for years and years and years and years. In terms of other charts, you can see that up at the top, foreign stocks were not a place to hide here today. EFA, which tracks the developed foreign world, was down 1%. The emerging market stocks were down nearly 2%. And again, remember, that's being dominated by China right now, and that's not a good-looking chart right there with EEM. A lot of those Chinese securities, whether you're talking about JD.com or Alibaba or Bilibili or Didi, or all those other fun names to say, they're all getting smoked in this market right now. And they're really bleeding over to the emerging markets in general here. That's an awful looking chart right there. In fact, it should be obvious why this chart has a dark pink background, whereas this one only has a light pink background. Right? This chart looks a lot worse. This thing is really bouncing down and away from that moving average, whereas EFA is trying to hang out at the moving average. Right? It literally was touching it earlier today. EEM hasn't touched the moving average for a week, and it just keeps on plunging lower and lower and lower. So that does not look good at all. Now, as you could probably imagine, Bitcoin was down today. It didn't do too tremendously bad. It was down only 2%. So I would say that that's kind of almost like a minor victory, considering that this is oftentimes viewed as a proxy for risk appetite, and today was definitely a risk-off day. So things could have been even worse for Bitcoin. It's hanging in there and just kind of moseying more sideways than anything here more recently. Let's go ahead and now take a look at our Sector 12 grid. This is chart 5C. And as you can see here, we've got kind of the lower right-hand corner filled with green and everything else pink. So there's some of the same themes we've been talking about for quite some time. Energy retains its strength from an intermediate perspective, still has a strongly bullish intermediate posture. It's at 88. It is falling, but remember, it'd have to fall below 80 out of the upper reversal zone before we would move to a bearish posture according to how you read the market forecast technical indicator. So it's got a little bit of flexibility up there since it had done so well before. You kind of give it a little bit of a grace period there. And to be fair, it's not like this thing is plunging through its moving average or anything. Yes, today was an ugly day for it, down 3%, but it had been up above its moving average so much that it can afford to give that back and still be in an uptrend. In terms of some of these other charts we've been talking about more recently, real estate and utilities have been doing a bit better. Real estate's actually had 2 really strong days up until today. It gave back 0.65% today, which was actually one of the better performing sectors. The best was staples. It was only down 0.09%. So all sectors were down, but staples were basically break even, and real estate wasn't all that far behind it. It closed lower by less than 1%. So it would have been considered the second strongest sector here today. But that's somewhat impressive because yesterday's candle and the day before were really dynamite for real estate. That's a great looking bounce move that took place right there. So I was happy to see it doing reasonably well today, even though the markets at large would have given it an excuse to sell off and perhaps take away much of those gains in the last 2 days, but it's actually held in there pretty well. So keep your eye on real estate. I know a lot more of the attention has been paid to utilities because they had this amazing, consistent, persistent move right here. But utilities have kind of started to go a bit sideways in the last week, whereas you're actually seeing a little bit more bullish evidence here out of real estate. So it's possible that real estate wants to take the baton and run with it for a little bit. So let's keep our eye on that moving forward. And as I mentioned before, staples, what can you say? They're just dynamite right now. All-time highs on staples, right? They did have an overbought cluster signal yesterday, so that goes to show you how strong they are. But the fact that they closed down just 7 cents here today just goes to show you that there is some strength in this market still. In terms of some of those other areas that really struggled today, again, energy was actually our worst performer today, but their chart looks a lot better than, let's say, communications. Of course, I'm sure David mentioned in his video for you last night that Netflix was the big story. In fact, I was talking about it because it happened in the after-hours session on Tuesday when I was doing the video. So we already knew in advance that Netflix was going to get massacred yesterday, and indeed it did. In fact, it ended up being worse than what was shown in the after-hours session when I was talking to you about it the night before. But today was no salvation, right? You might think, well, maybe we're due for a bounce because the selling got too hard. Nope. Take a look at XLC. It was down 2.85% today. We are at new multi-month lows for XLC. So it is the worst, especially on a market cap basis, right? You don't always see that on my sector selector because that's a equal weighted approach towards the sectors. But certainly on a market cap weighted perspective, XLC is the worst sector chart that we have out there, right? Not only was it the second worst performer from a sector perspective today behind energy, but unlike energy that's still in an uptrend and could afford to give back some of its gains, XLC is in a completely different universe. We are talking about a brand new, fresh, multi-month low here. We have plunged below the lows of February and March. You cannot make that claim with any other sector that's on the board right now. It's not that the other sectors all look great, but none of them look as bad as communications look right now. So not a good look there at all. Technology had a tough day as well. It was down 1.7% there. Financials struggled as well, down 1.58%. Materials were down 1.6%. Even utilities were down 1.6%. So it was pretty ugly out there in most areas, unless you were fortunate to be hanging out in the consumer staples or maybe got lucky with a few one-off situations like I had mentioned before with Verizon or Bristol Myers Squibb or something along those lines. So tough day, regardless of what kind of setup you had. It was an aggressive sell-off type of a day, and the worst of the selling took place there with energy and communications. All right, let's get into our trade application example for the day. And it's actually going to come from the materials space. It's probably one of those sectors I don't talk about as much, not necessarily because I have anything against them, but there's just not a lot of materials companies out there. And the ones that are out there tend to be extremely cyclical. So they don't really mesh up well with what I try to teach my students, where we're looking for consistent business models that will lead to ultimate dividend growth as time goes on. So materials is one of the least referenced sectors that I probably bring to folks' attention. But today, something did catch my eye in that regard. Most of you know my process, right? When we're looking at a big sell-off day like today, I want to go hunting for opportunities through the world of sold puts. And we've got a lot of them on right now. And guess what? We're making money on every single one of them. So for people that say that you can't make money in a more difficult market environment by placing bullish trades, I would urge them to look at our sold puts. All of them that I've done in the last couple of months here in this presentation are profitable at this exact moment in time, despite what feels like a difficult stock market. So it can be done. I'm not saying that it's a layup or it's a guarantee, but if you're cautious around how you approach your strategies, you can still do bullish strategies in difficult markets as long as you're giving yourself plenty of flexibility. And that is the nice thing with selling puts. It provides that excellent flexibility because of the way that you sell out of the money strikes, where you set the odds in your favor to begin with. So let me show you what I was looking at here today. And remember, the trade is already done. It's always the case. We do the trades while the market is open. Send that information out to all of our premium members on our Telegram Trade Alerts app. So, and that way they get access to information prior to everybody else that sees the free video later on in the night or the next day or whenever you watch the videos. So, let me pull up the chart. Sorry, I pulled up the wrong chart there for some reason. 2A is what I wanted. On 2A, this is our dividend stair-step chart. And there's a stock that we actually bought in my dividend growth investing class maybe 3 years ago, somewhere in that general time period, but has not popped up since then. And we actually did quite well with it over the years up until more recently. And this is Scott's Miracle-Gro. Of course, yesterday being 420 and all the hilarious marijuana jokes out there on 420. And of course, there was some marijuana news, I think, today as well, with some additional states legalizing it. It didn't really seem to benefit those pot-related plays. This is kind of a quasi-pot-related play. Some of you may not be aware that Scott's Miracle-Gro, ticker symbol SMG, actually has, I believe it's the Hawthorne division, that caters directly to folks that grow their own marijuana plants. And they have grow lights and all this kind of stuff that is becoming a more of a growth industry now that the legalization has happened in so many states out there. I happen to be living in a state where it's not legal, and I don't anticipate that it will be legal here anytime soon. Nonetheless, I know for the rest of you in the United States, there's a pretty good chance that you're living in a state where it has become legal here more recently. And so it's becoming a bit more of a growth business as well. And so when we last bought Scott's Miracle-Gro in my dividend growth investing class, it must have been over in this time period right here where it had dipped into the blue zone of the dividend stair-step chart. For those of you that are not familiar with this chart, it is a proprietary chart that is calculated unique for every single different dividend stock out there. So it adjusts based upon that company's specific yield history. And so with this particular chart, we like to buy when stocks are in the blue, and if we ever sell them, we would sell them when they get into the orange. But whether you sell a long-term investment, of course, is up to you. But in general, the main idea is to buy when they're in the blue, because what that suggests is that the yield on that company currently would be attractive compared to its long-term historical measures. And so in this particular case, you'll notice that Scott's Miracle-Gro, from back here when we bought it in the class, when it was a $60 stock or whatever it was, ultimately went to $254. For a while, it was one of our best ever dividend stock selections. But you can see that it's kind of unwound much of that froth since then, as that enthusiasm around marijuana kind of has waned just a little bit over the years. So now we're into this heavy sell-off period where we've got this oversold cluster signal, and you can see that we're still far away from the blue line where we'd be buying it outright in my class, and that's why it opens itself up to the opportunity of selling a put. because what I did was I sold the June $75 put, and we got 1% return on risk for that. In fact, I think we got 80 cents is what we got on that particular trade. And so basically, we get $80 in our pocket today to say that we'd be willing to buy Scott's Miracle-Gro at $75 a share in the middle of June if it falls from the current 108 all the way down to 75. And of course, that's going to take a much more aggressive sell-off than what we've even witnessed here more recently. Now, they do have an earnings announcement, so this trade is not for everyone. You do actually have to want to own this company in order to enact this trade, because eventually you do a trade like this often enough, and eventually they will start closing in the money. But what you're hoping is that you're giving yourself enough flexibility between 108 and 75, where even if this continues to have negative price momentum, as long as it doesn't plunge all the way down here, you will still win the trade. And if you don't, and if it comes down below 75, then you get to buy that company at what would be an attractive yield at that time, right? Right now, it's 2.44% dividend yield. But at $75, it would be well in excess of a 3% dividend yield, because that starting blue line right there is a 3.07. So it would probably end up being like a 3.2% yield, which history suggests would be an attractive time to be locking this down for the long term. Okay, so that's what I had for you. Hope you enjoyed tonight's presentation. If you did, do me one favor, take 5 seconds out of your day and click like for me there on Twitter. If we're up and over 100 likes, I'll plan on doing another full-length video for you on Tuesday. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.